So let's just say that Taylor hears about all these different cafeteria plans, and he says, you know what, I actually like the health savings account. Okay, I'm more interested in the health savings account. Why don't you walk me through what an HSA is, and let's help Taylor out. Okay, so if you remember when we did the traditional Roth, I showed these two pictures. And if you see, the HSA is the trifecta of tax benefits because it offers all three tax benefits. Okay, it's the only account that offers all three tax benefits. So I always pull this visual up with clients because it really emphasizes how important and how great this HSA really is. Okay, before I go on, I forgot, I'm going to talk about high deductible health insurance. So with the FSA, you don't need to have any type of health insurance plan. Like, you could have any type of health insurance plans and still qualify for FSA. But for an HSA, you need a specific plan called a high deductible health insurance plan. And usually for these plans, it's more for young people who are relatively healthy that don't need to go to the doctors very often. Because the way health insurance works is that if you pay a premium with high deductible health plans, the premiums are lower. So the monthly cost for high deductible health plans is a lot lower than other insurance plans. And that's because they're saying that I don't need to go doctors very often, so there's not a high cost to go to the doctors. It's really for emergencies where if they go skiing, they get into a bad accident, then that's when a high deductible health plan would work. So really great for young people who don't really go to the doctors very often or don't have a lot of medical problems. Okay. Now the other health insurance is a premium where it's higher, but the thing is, if you go to the doctor, you pay, they call it a copay, where you pay only like $15 per visit. Okay. So, and then the insurance covers the rest. So in a way, with the other insurance plan, you are paying higher monthly, but because every time you go see a doctor, it's a little cheaper. Okay. So those plans are good for family, especially families that have health issues, a lot of health concerns. So that's where most people who go work at a company, they try to get that insurance plan. But for young people, high deductible health plan is probably the best route to go. And HSAs is only qualified if you have a high deductible health plan. So if you have the other health plan, you can't do an HSA. They won't let you. Okay, so what you could do is when you have a high deductible health plan, this is when you can contribute into an HSA account. And even maybe a year later, you switch to the other insurance plans where you don't qualify for HSA anymore, you still keep your HSA. You could still use it for medical expenses and it still stays with you. So the only time it matters is if you want to put money into the HSA, you have to be able, in that same year, you have to have a high deductible health plan. Okay. Now, there are other benefits when it comes to having an HSA, is that long-term investment potential. So because the money that goes into the HSA is an investment account as well, it will grow. You could select stocks and stuff inside of it and it just grows. And if you just, what I advise to clients is that even if you have health costs that, maybe a doctor visits here and there, don't use the HSA. Just pay out of your own pocket. Keep the HSA inside, keep the money inside the HSA for as long as possible because you want it to grow tax-free. Because later when you're older, and you can take that money out and it won't be taxable, right? So you want to keep as much money inside the HSA account for as long as possible. So I always tell clients that if you have the cash outside of the HSA, use that to pay for your glasses, your general office visits for doctors. So you want to keep as much money inside the account as possible. The next thing is flexibility and portability. Unlike the FSA, if you leave the company or the year ends, you lose out on an account. With the HSA, this is the client's money. The client keeps it. They could, if they switch companies, it goes with them, right? So it's under their personal name. So that's really important that because there's so much money that could be put into an HSA over time, they want to have that flexibility to carry it around with them and not fear that it might be lost. And the last thing is it could be used as an extra retirement account. There are certain rules to qualify for, so it could act as another IRA. Okay, So very important that this is another potential strategy as well. Okay, I always tell clients that most likely you don't need to do it as an extra IRA because you're going to have health expenses when you get older anyways. So it's probably just better just to use it on medical expenses. What question do you need to ask clients before you start offering the HSA? The first question is, do you have a high deductible health insurance plan? If it's no, then you do not qualify to contribute to the HSA. But if it's yes, now we ask, okay, do you know if your employer offers it? If your employer offers it, then you're going to want to go through the employer route and use the employer's account to contribute to the HSA. And the big bonus here is that sometimes an employer will actually fund the HSA for employees. Okay, so really important that if the employer is willing to pay for it, just like 401k match, if the employer is willing to put money into the HSA, definitely take it. Okay, but sometimes the employer doesn't offer it, which is fine. They just have to open up a separate HSA account, just like opening up a bank account under their name, and they just put money into the HSA every year according to whatever the threshold is for that year. Because the contribution amount changes every single year as well. Okay, so, and then do it again next year, and do it again next year. That's the most important part at the very bottom, is that we don't just do it once. We want to make sure we keep it consistent and do it every single year, because remember, compound earnings is really effective and really important in this situation, because the money they put into the HSA, so if they're single, I think it's like around $3,000 or so. If they put $3,000 in every single year, it's just going to compound. Like they could do it for 10 years, right? So really important that we tell clients that it's not just a one-year thing. It's going to be every single year. So this one advice I give you is not just saving you taxes 1 year, it's saving you taxes every single year after that, okay? And the thing about giving advice to clients is that most of the stuff the first year of advice is gonna be a lot of information to give to the client, but after the first year and a client does all those things that we told them, the second, third year, it's just maintaining. That's all it is, it's just maintaining. So the first year is always the hardest because it requires clients to like open accounts and put money in and figure out how to do that. But after that, it's just maintaining. It becomes really easy. So just getting over that first initial hump for the client is probably the toughest. But after that, it's the savings just add up.